Have you ever stood in the eye of a hurricane? They say it's a bizarrely calm place. The sun might even be shining. All around you, a storm of incredible force is raging, but in that small, central pocket, there's an eerie silence. That's a powerful metaphor for where our economy might be right now. We're in a period of what feels like stability, a quiet phase where the markets seem to have found their footing. But history has a habit of repeating itself, and it whispers a chilling warning. This kind of silence often comes right before the storm breaks. Let's take a trip back in time. The year is 1928. The Roaring Twenties are in full swing. Jazz is in the air. Innovation is everywhere. And the stock market seems like a one-way ticket to wealth. People believed a permanently high plateau had been reached. Volatility was low, confidence was sky high, and everyone from factory workers to business tycoons was borrowing money to buy stocks. The market was calm, predictable, and incredibly reassuring. But beneath this placid surface, immense pressures were building. Excessive speculation, rampant use of leverage, and a fragile banking system were creating a bubble of epic proportions. The silence wasn't a sign of health. It was the sound of a system stretched to its absolute limit just before it snapped. We all know what happened next. The catastrophic crash of 1929 and the Great Depression that followed. The calm was just a deep breath before the plunge. Now, let's fast forward a few decades. The year is 2006. The world had recovered from the dot-com bust and a new era of prosperity seemed to be underway. The housing market was booming. It felt like everyone was getting rich. Flipping houses became a national pastime. Banks were creating complex financial instruments like mortgage-backed securities and collateralized debt obligations, which were given top ratings by credit agencies. The prevailing wisdom was that housing prices could never go down on a national scale. The market felt stable, almost boringly so. The VIX index, often called the fear gauge, was hovering at historic lows. This calm gave birth to a dangerous assumption that risk had been tamed, sliced up, and distributed so widely that it was no longer a threat. But this was an illusion. The risks weren't gone, they were just hidden, buried deep inside these complex securities that almost no one truly understood. The quiet wasn't safety, it was the sound of a ticking time bomb. When subprime mortgages began to default in 2007, the entire global financial system shuddered, and then, in 2008, collapsed. The silence was broken by the sound of crashing markets and shattering lives. And it doesn't even take a huge crash to prove the point. Think about late 2019. The global economy seemed to be chugging along just fine. Trade was flowing, unemployment was low in many countries, and markets were hitting all-time highs. There were some worries, sure, trade tensions, geopolitical rumblings, but these were largely dismissed as background noise. The general feeling was one of stability. The system felt resilient, yet under the surface, fragilities were multiplying. Supply chains were stretched thin, optimized for efficiency, but not for resilience. Many businesses and households were carrying significant debt. Then a microscopic virus emerged and exposed the system's brittleness in a matter of weeks. The calm of 2019 wasn't a sign of strength. It was a mask for deep-seated vulnerabilities. The pandemic didn't create all the problems. It simply revealed the ones that were already there, hidden by the deceptive quiet. So what's the common thread here? In each of these periods, 1928, 2006, 2019, the calm itself became the biggest risk. When things feel stable for a long time, human nature kicks in. We get complacent. We start to believe that this time is different. Our perception of risk warps, volatility drops, which ironically encourages people to take on even more risk, believing the environment is safe. Financial innovators create new, ever more complex products that promise high returns with low risk. And in a calm market, these promises seem believable. Warning signs, the few brave voices who dare to question the narrative, are dismissed as pessimists, Cassandras, or simply out of touch with the new reality. The economist Hyman Minsky described this phenomenon perfectly. He argued that long periods of stability are inherently destabilizing. They breed complacency, encourage excessive risk-taking, and ultimately sow the seeds of the next crisis. The quiet phase is the moment when risk stops being questioned. And that's precisely when it's at its most dangerous. It's like driving a car at 100 miles an hour on a perfectly smooth, straight road. You feel completely in control, so you might take your hands off the wheel for a second, but that's the moment. A small bump or a slight curve can lead to disaster. Think about it this way. The economy doesn't usually break when everyone is terrified. When fear is high, people are cautious. They save money. They deleverage. They scrutinize every investment. Fear acts as a natural brake on the system. The real danger comes when everything feels normal, when everyone is confident, when the consensus is that the good times are here to stay. That's when we collectively let our guard down. That's when the big mistakes are made. This feeling that everything is fine is perhaps the most reliable indicator that something is not. So, where are we today? We're living in another one of these strangely quiet moments. After the chaos of the last few years, the pandemic, the supply chain disruptions, the surge in inflation, the aggressive interest rate hikes, things seem to be settling down. Inflation is cooling, markets have been resilient, and there's a growing narrative of a soft landing. The idea that we've tamed inflation without triggering a major recession. It feels good. It feels calm. But if history teaches us anything, it's that this is the exact moment to be most vigilant. Are we asking the right questions? Are we looking under the hood? Or are we just enjoying the quiet ride, assuming the road ahead is as smooth as it appears? The pressures are still there, even if they aren't making headlines every day. We have unprecedented levels of government and corporate debt around the world. Geopolitical tensions are arguably higher than they've been in decades. We're in the midst of a massive technological shift with AI that could create unpredictable economic dislocations. And commercial real estate in many cities is facing a slow motion crisis. These are not small things. These are tectonic plates shifting beneath the surface. Yet the market surface appears relatively calm. The silence we're experiencing isn't a guarantee of safety. It could very well be the calm before the next storm. It's the period where the hidden risks, the ones we aren't talking about, the ones we've dismissed, are quietly gathering strength. This calm isn't new. And if history is any guide, it has never lasted. The crucial task for us is not to be lulled into a false sense of security, but to use this quiet time to prepare, to question, and to remember the lessons of the past. Because the storm always comes eventually, and it's those who listened to the silence, rather than being deafened by it, who are best prepared to weather it. Thanks so much for watching. What do you think? Are we in a deceptively calm period? Or is this the real deal? Let me know your thoughts in the comments below. And if you found this perspective valuable, please hit that like button and subscribe for more content that looks beyond the headlines. See you in the next one.